Welcome to the deep dive. Today, we're taking a close look at Palantir's Q2 2025 earnings. The early signs point to, well, a pretty astonishing impact from AI leverage, numbers that seem to obliterate the metrics, really. So we're here to unpack all that, the numbers, the strategy, get right into it.
Exactly. And our goal here for you is to really pull out the most important bits of insight from their earnings call, their financials. Think of it as your shortcut to getting properly informed on what Palantir is actually doing and, how their unique strategy is unfolding.
Okay, let's get started then. Let's peel back the layers. What are the headline figures? What really jumps out from Q2?
Well, the first thing that really hits you is their Rule of 40 score. It came in at 94%.
94,
Yeah.
wow.
And, for listeners, the Rule of 40, it combines revenue growth rate and profit margin, EBITDA margin specifically. Getting over 40% is good, healthy. Their CEO even said getting into the 50s, 60s, 70s is considered pretty baller.
So 94 is kind of off the charts then.
It really is. It's a powerful signal. It means they're not just growing fast, they're doing it really profitably, really efficiently. It suggests, a highly scalable model where adding revenue doesn't cost them proportionally as much. Sets them apart.
Okay, incredible efficiency. And how did that feed into the top line revenue figures?
So overall revenue, it hit $1.004 billion. That's up 48% year over year.
Almost 50% growth.
Solid, very solid.
Yeah.
And the U.S. business was particularly strong. It surged 68% year over year to $733 million.
68% in the U.S. alone.
Yep. And if you break that down further, U.S. commercial revenue, a remarkable 93% year over year increase, hit $306 million.
92%, okay.
And U.S. government also grew strongly, 53% year over year, up to $426 million.
Those are some incredibly strong numbers, especially stateside. But okay, big revenue figures are one thing. How does this translate into actual deals, business momentum?
Right, that's the key question. And it translates into, record-setting deal flow. In Q2 alone, they closed 157 deals worth at least $1 million.
Okay.
And it wasn't just volume. 66 of those deals were worth $5 million or more, and 42 deals were over $10 million.
So significant value in those deals, too.
Definitely. And the total contract value, the TCV, the total value of contracts signed, that set a record at $2.27 billion, up 140% year over year.
140% increase in TCV.
Huge jump. And U.S. commercial TCV also hit a record $843 million. That's up an incredible 222% year over year.
Wow. Okay, so it's not just headline growth. They're embedding themselves deeper, closing bigger deals, more deals. It speaks to real penetration, doesn't it?
Exactly. It's broad-based momentum.
And looking forward, their guidance suggests they expect this to continue, right? For Q3 and the full year.
Yeah, guidance remains strong. Continued expectations for revenue growth, especially, again, in that U.S. commercial segment. They're clearly not planning on slowing down.
All right, those financials are definitely eye-popping. But let's connect it back. Everyone's talking about the AI revolution. How much of this success is really down to that? How is Palantir's software, their AI specifically, delivering this kind of tangible impact for customers?
Well, that's where you see some really striking examples. The speed of value realization is key. Look at Citibank. Customer onboarding, KYC checks, security, used to take 9 days.
9 days, okay.
Now, mere seconds. Using Palantir's platform.
Seconds. That's transformative.
It absolutely is. Or Fannie Mae. Uncovering mortgage fraud. That went from 2 months down to seconds.
2 months to seconds.
Yeah. Saving the housing market potentially millions in future fraud losses. It's almost like, they've unlocked some kind of cheat code for these big enterprise problems.
And you mentioned the Maven smart system adoption.
Right. The adoption rate there is just wild. Usage doubled in the first 9 months of 2024. Then it doubled again in the next 5 months. And since February, it's doubled yet again. That's just incredible acceleration.
That kind of rapid adoption definitely tells a story. But what's underneath it? What's the tech differentiator allowing the speed? Is it just LLMs or something more?
That really gets to their core approach. Their CTO talks about needing this elegant integration of LLMs, workflow, and software. And, LLMs, large language models, they're powerful, but in an enterprise setting, they need context, they need structure.
Right. Raw data isn't enough.
Exactly. And he says this integration is only possible because of their deep investment in ontology. Think of ontology as like a smart map of all the organization's data. It understands the relationships.
So the AI can reason over complex, messy enterprise data, not just process text.
Precisely. And that's the key. Their AI platform, AIP, isn't just software clients use. It's software they're building their own software on. There was this example. Chris Johnson, co-CEO of Teletracking,
Yeah.
replatformed on AIP, went public about it. And apparently he was just flooded with inquiries from CEOs and CIOs. And Palantir CEO Karp, he talks about providing an unfair advantage for allies, friends, compatriots. It's about building a company where every single component is value accretive, almost no parasitic elements.
That's a bold phrase, unfair advantage. Is there a risk, though? Does focusing only on allies and compatriots limit their market? Or does it actually build a stronger moat?
Well, it's definitely a strategic choice they're making. The bet is that by focusing on these deep partnerships with aligned groups, they create more powerful integrated solutions. And speaking of customers, the total count hit 849. That's up 43% year over year.
So growth in customer numbers, too.
Yeah, and they're deepening existing relationships. Average revenue from their top 20 customers, up 30% year over year. Now it's $75 million per customer, trailing 12 months.
75 million average from the top 20. Wow.
It shows stickiness. And the breakdown for first half of 2025, 72% revenue from the U.S., 28% non-U.S., segment-wise 55% government, 45% commercial.
And you mentioned something about how they count government clients.
Right, yeah. It's interesting, even divisions within a large agency like FDA, CDC, NIH, all under Health and Human Services, they count them as separate customers.
Okay, that gives a more granular view of their government footprint.
He does.
Now, speaking of unique approaches, their sales model, it's famously unconventional. How does this small sales force, no direct sales idea actually work? How do they land these huge deals?
Yeah, it ties back to that no parasitic elements idea. They deliberately keep the sales force small. The CEO says no direct sales means they don't have like 10,000 people roaming around selling something they don't understand.
So quality over quantity.
Sort of. The advantage, he argues, is enormous credibility. When they show up, clients believe Palantir will genuinely make them a lot of money, save them expenses, or make their soldiers safer and more lethal.
That's a powerful claim to credibility.
It's very deliberate. And it seems rooted in their internal culture, too. Described as having very little BS internally, a flat hierarchy, staffed by, quote, the most qualified and interesting people, heterodox in their beliefs.
Heterodox, so encouraging different ways of thinking.
Seems like it. The CEO also pitches working at Palantir as the best credential in tech, moving people from platitudes to the front line where things matter, aligned to a higher purpose.
A strong mission-driven narrative. It attracts a certain kind of person, I imagine.
Huh?
And client.
Clearly, it resonates with their target base.
Okay, sounds like a very intentional, tightly run ship. Let's pivot to the financials again, the backbone. How stable are they? What are they doing with their capital?
They're sitting on a very strong cash position, $6.0 billion in cash, cash equivalents, and short-term U.S. Treasuries.
$6 billion. Okay.
And they're generating a lot of cash. In Q2, $539 million from operations, that's a 54% margin, and $569 million in adjusted free cash flow, a 57% margin.
Those are very healthy margins.
Extremely healthy. And this financial strength lets them do things like the ongoing share repurchase program. They authorized $1 billion. As of June 30th, they still had about $899 million left on that.
So buying back their own stock, a signal of confidence in their own valuation.
That's generally how it's interpreted, yes. They believe the stock is undervalued.
Right. A robust picture, significant cash, strong cash flow, returning capital. But no company, especially one growing this fast with such a unique model, is without risks. What are the key things we need to keep in mind for balance here? What are the potential headwinds or challenges maybe unique to Palantir?
Absolutely, that's crucial. Let's break down some key considerations.
Okay.
First, you've got growth and market dynamics. Sustaining this kind of rapid growth, always a challenge. For Palantir, it's compounded by those long, sometimes unpredictable sales cycles, especially with big government and enterprise deals.
Right. Those don't close overnight.
Not at all. And there's customer concentration. The top 3 clients made up 17% of revenue in the first half of 2025. Some have been clients for like 13 years on average. That's deep reliance.
Significant reliance, yeah.
And an interesting point on contracts, that $5.4 billion in remaining deal value they reported at the end of 2024. A lot of government contracts have termination for convenience clauses. The government can just end the contract under certain conditions, so that TCV figure isn't always guaranteed revenue.
That's a really important nuance for government work. Okay, what else?
Second, operational and talent complexities. Their platforms are complex. Implementation takes time, requires ongoing support, and there's very little room for error. Mistakes can have big impacts reputationally or financially.
High stakes.
Very. And talent. Finding and keeping top engineers is tough everywhere. Intense competition. Even with their best credential pitch, stock price volatility could impact retention.
Makes sense. And the third area?
Governance and legal scrutiny. They're facing ongoing securities class action lawsuits. They were dismissed, but an appeal's been filed. There were also derivative actions. Those were dismissed. But it just highlights the increased legal risk as they grow, especially operating where they do.
And their share structure.
Right. The governance is notable. They have a multi-class stock structure, Class A, Class B, Class F shares. This heavily concentrates voting power with the founders, so other stockholders. Their influence on strategy is pretty limited compared to with a typical structure.
Okay, so founder control is strong.
Very strong. Also, no cash dividends historically. Don't expect them soon. They reinvest earnings for growth, buybacks, and just a specific detail noted in the filings, $10.2 million incurred for the CEO's use of a non-commercial aircraft in the first 6 months of 2025. Business and personal travel.
10 million.
Okay.
And finally, broader economic factor.
Yeah. The usual suspects, macroeconomic headwinds, inflation, geopolitical tensions, all that could impact customer spending demand. It affects everyone to some degree.
That's a really thorough rundown of the landscape. Lots to consider there. Of all those, what do you think is the most significant strategic challenge for Palantir's long-term vision? And how does their unique culture maybe help or hinder them in tackling it?
That's the core question, isn't it? I'd argue it's that combination of growth sustainability and customer concentration. Their whole unfair advantage, deep partnership model creates incredibly sticky relationships, which is great, a real moat. But it also means they're heavily reliant on a relatively small number of huge clients, particularly government. That makes them vulnerable, vulnerable to policy shifts, budget cuts, even just one big client changing direction.
Right. So the strength is also the potential vulnerability.
Exactly. Their unique culture, that mission-driven focus, it definitely helps build that trust needed for those deep relationships. That's their edge. But it also means they probably don't go after every single market opportunity, which might limit their overall growth ceiling compared to a more broadly focused software company. The challenge is scaling, expanding their reach without diluting that core credibility, that deep partnership model that got them here.
So wrapping this up, we've seen Palantir showing truly remarkable growth, fueled by, well, genuinely astonishing AI impact, translating into big deals, real customer value. But on the other hand, they operate very differently. Unique sales, unique governance, deep but concentrated relationships. And that comes with its own set of risks: concentration, complexity, legal scrutiny. It's really a fascinating case study.
It really is. And maybe the final thought for you, the listener, is this. Thinking about Palantir's whole unfair advantage idea, their specific mission-driven culture, that concentrated power structure, all happening in this fast-changing, often politically charged tech landscape.
Yeah.
How might that distinctive identity keep shaping where they go next? What new challenges or maybe new opportunities might this very unique way of doing business unlock for them down the road? Definitely a company marching to its own beat.